webinar is to talk about the USDA loan program. We're going to start out just with a quick intro of American Mortgage Service Company. We have been a mortgage banker since 1975. We're independently owned and operated. We are a purchase-oriented lender. Year to date, somewhere north of 70% of our business, even in what is a very, very heavy refi year for most people in our industry. Over 70% of our business here at American Mortgage continues to be purchase business. We are a purchase-oriented lender. Not that we don't do refinances. We do, primarily for past customers or referral-only type. We don't do much soliciting for refinance business. The purchase business is our focus. We offer all the programs that are out there today, FHA, USDA, VA, conventional. We also currently lend throughout half a dozen states. We're based in Cincinnati, Ohio. We have offices throughout Ohio, Indiana, Kentucky, Tennessee. We also lend in Mississippi, Arkansas, West Virginia as well. So welcome to the USDA RD GRH program. What do all these initials mean? The USDA is the United States Department of Agriculture, of course, and within that you find the Rural Development Division. And the Guaranteed Rural Housing Program is within that. And I mention this because you might hear this same program referred to multiple ways. I know I do it myself. So one minute I'm saying the USDA program, the next minute I say RD, the next minute I say the Guaranteed Rural Housing Program. Usually we'll either hear RD or maybe USDA. But it is one and the same program generally when you hear people refer to it this way. We're talking about the single-family Guaranteed Rural Housing Loan. So what are the big benefits of this program? What makes it such a great program? The USDA program allows buyers to purchase with no money down, no down payment. Sellers are allowed to pay closing costs and or prepaids. Buyers can use gift funds if they want to have a down payment or for their closing costs. They could also use down payment assistance funds, DAP funds, from the state housing finance agencies. The Ohio Housing Finance Agency, the Indiana Housing, the Kentucky Housing, those programs allow the use of the USDA loan product with their programs. And we participate in each of the states with the applicable state housing program, the bond loan programs. Also, under the USDA program, it's important to note that buyers are allowed to finance 100% of the appraised value, not just 100% of the purchase price. So here's an example. Let's say the contract is written for $123,000 with the seller paying $2,000 toward closing costs. Then the appraisal comes in, and let's say it appraises at $125,000. The borrower could actually finance $125,000 before the financing of that guarantee fee. We'll talk about that in a moment. So in this scenario, the buyer would have no money down. They'd have $2,000 of their costs paid by the seller, and up to $2,000 they could finance right into their loan if needed. And that's because the USDA program allows a buyer to finance 100% of the appraisal value. The program is strictly a 30-year fixed-rate loan. There's no PMI, there's no private mortgage insurance on this because it's not a conventional loan. There is a guarantee fee, and the structure of the guarantee fee is very similar to the MIP or the mortgage insurance premium that we have on an FHA loan. There's an upfront fee, it's 2%, it's financeable, and there's an annual fee at 0.40% of the loan amount, and then that is paid in monthly installments just like MIP is with an FHA loan. So instead of private mortgage insurance, there's a guarantee fee, there's an upfront portion that's almost always just financed right in the loan, and then there's an annual that's paid in monthly installments. That 2% guarantee fee is based on the total loan amount. It's kind of interesting the way it's structured. So since the 2% is actually based on the total, including the fee itself, the way that we calculate the loan is we take the loan amount before the fee, and then we divide it by 98% to come up to what the loan amount will be. So you see on your screen now an example, $125,000 divided by 98%, or 0.98, gives you a loan amount of $127,551. And 2% of that $127,551 subtracted back off of there would bring you back down to your $125,000. So fortunately these days it's calculated by the loan origination system that the lender uses anyway. The annual fee is based on that total as well, but the way that it's calculated is not a straight 0.40 times the loan amount, because there's a declining schedule knowing that the loan balance is declining over time. But estimating it at 0.40 is a safe estimate. And here's an example of estimating that. So we have that 127,551, and we take the 0.4% or 0.004, multiplied by that loan amount, divided by 12. There's the monthly, $42 and some change. But then when it's actually put into the system, and the system calculates it again, because of that declining balance, it's actually a few pennies less than that, about 30-some cents less in this example. For a borrower to qualify for this program, the debt-to-income ratios are 29 and 41, and we put the 0.0 on here to just kind of illustrate how on this particular program, particularly if it has to be a manually underwritten file, lenders are encouraged to stick pretty tight to these debt ratios. Now, one of the interesting things about the USDA program is that each state has its own office or offices for USDA, and their interpretations from state to state or even from office to office can vary slightly. But the DTI guidelines are 29% and 41%. So the housing should not exceed 29% of the borrower's qualified gross monthly income, and his house payment plus all other recurring monthly debt, 41%. And 29 and 41 are the old FHA guidelines as well. It's for a single-family owner-occupied purchase only. There is a refi auction, just so you know, of an existing USDA loan to a new USDA loan. Borrowers normally cannot own another property at closing. There can be some exceptions for that, and if you run across those instances, I would suggest that you talk with your mortgage loan originator who you regularly work with, who can get the details and check with underwriting, check the guidelines, check with underwriting, so that people are going in the right direction. Also of note here on USDA loans is that the site or the land-only value cannot exceed 30% of the total value of the property. This is for homes in rural areas, but it's not for huge tracts of land or for working farms. Now, what are the limitations on the program? There's basically two. There's a household income limit, and again, this is not a borrower income limit. This is the entire household. There is a household income limit, and they're fairly generous, and the property itself must be in a designated rural area. And currently, we're using census data from a number of years ago, and the information is available on USDA's website, and there's a link for it here on your screen. So we go to that website and we pull up, and let me just give you an example. When I click on that link, it takes me to USDA's website. And on the USDA website, I can go over here to the left, and I can go to income eligibility for single-family housing, and I can actually get charts that will show me what the income limits are for state and county. And property eligibility, I can go to single-family housing right here, and I can look up a property by using the maps, and I can zoom in or zoom out of the maps. And I would suggest if you run into a situation there where you'd like some assistance, again, just contact your mortgage loan originator, and they'll be happy to assist you with this. On the appraisal, it's generally a a typical appraisal. The appraiser does have some specific language that they need to put into the appraisal. When we order an appraisal, for example, we identify the loan type, of course, and remind the appraiser that the appropriate verbiage needs to be included in the appraisal. The house essentially has to be safe, sound, and secure. Honestly, these days there's very little difference in an appraisal from one product to another. They kind of are what they are. We all want our customers to be buying a property that's safe, sound, and secure. The property does need to be a residential single family, no working farms, and properties with excess acreage can be a problem. And if someone runs across a property that they're not sure about, again, they can contact their mortgage loan originator, and we can get some details, and then we can do a little research and confirm whether or not we might have a problem. If it's on a well or cistern, then there is a test required. If it's a septic, on a septic, which is pretty typical in rural areas, if it's been vacant, if the property is vacant, or if the appraiser suggests that a septic inspection be done, then we're going to have one. These types of inspections, our clients ought to be getting these anyway, right, to make sure that they're not going to have any problems with their property. We're talking about a program where people are buying with very little or no down payment and minimal reserve requirements. We don't want them to get into a house, first of all, where they have any kind of health concerns for them or their family, and secondly, where they have any expenses, unanticipated expenses, after they move in. So inspections are a good idea anyway, obviously. Of course, if the appraiser requires any inspections or any specific repairs, we have to deal with those. And if it's new construction, we also require a thermal plan cert. The new construction, this program works very well for new construction. The USDA program does. We do a good amount of it. Most lenders submit USDA loans through the USDA's GUS, which is Guaranteed Underwriting System. It's their AUS. It's their automated underwriting system. It's similar to Fannie Mae's DU or Freddie Mac's LP, Loan Prospector. It is specific for the USDA program for guaranteed underwriting, the Guaranteed Underwriting System, or GUS. So most lenders today use this, and we've been using it for a long time. Our loan originators submit their loans directly through the GUS system and know if there's a potential problem or if it looks like it's being recommended for approval. Now, it's still reviewed and underwritten by an underwriter, and then after the lender approves the loan, the USDA also must review it. So in Ohio, it goes to the USDA office in Columbus, or I think they have a couple of other locations, Hillsborough and someplace up north, I can't recall, but it gets sent to them for review. And lenders who participate with GUS, normally the package that is sent to the USDA to review afterwards is a very thin file, unless it was flagged by GUS as at random for a quality control check, basically, and then a full file was sent. Or if GUS flags the file as needing to be a full manual review, then there would be a full file. USDA then issues a conditional commitment, and then the loan can be closed. And due to some significant budget constraints at the federal level, the USDA has had some staffing challenges in recent months and this past year. And I would suggest, due to that, their turn times are not where they would like for them to be. They've been as much as a full month to review a package. They're not there right now. It fluctuates with volume, of course. But the suggestion here would certainly be to plan accordingly, and from the application to the closing, I would suggest planning at least 45, if not 60 full days, so that the lender can get through the process of underwriting and processing and approving the loan, then sending the package to USDA to review and issue that commitment. So that whole process may take 60 days. And again, that's from application. So customers who write a contract and don't apply immediately, we need to pay attention to that as well. So we appreciate you taking the time to join us today for this kind of high-level review of the USDA program. If you have any questions at this time, please feel free to input them to the right side of your screen there, and we can go through the questions. Also, please contact your American Mortgage Loan originator with any questions that you have, the person that invited you to this morning's webinar. We'd like to do additional webinars in the future, and if you have specific topics of interest, please feel free to let your originator know so that we can get valuable information in front of you to help you do what you do. And working together, we can assist a lot of buyers get into the best program for their situation and into a home.